This is Tom Asprey. Thank you all for joining me. You should be seeing the YouTube page for the Viper Report. Those of you who haven't found this, we put all the videos up here. This session today will be up next week sometime. Also, we have past ones that explain some of the methods that I use, as well as market commentary. You can see there's quite a list. So using the free sites, how to set up in stock charts, some of the things we'll be talking about today, and other various commentaries. So you can either just bookmark it or sign up to subscribe to it. I usually will send out an email when I do a new one as well, so you can also find them in that manner. So today, let's first of all look at the markets. As usual, we're going to try to make this last till about 11:30. Quarter to 12 at the latest. Pretty ugly action yesterday. Another, tweet storm, and it was the advanced decline numbers were big enough to drop all the daily AD lines back below their moving averages. You can see that this is the NYSE all AD line. It was above its moving average up till Friday's actions, back below it. So this is the important support we're watching from earlier in August. Long-term uptrend, still well below the market. Below this, we have the NYSE stocks only, and it didn't look nearly as strong on the rally and is also back below its moving average. It's important to note that we just tested the 20-day EMA on this last rally. So during the week, I thought we'd need some more chopping and filling because, as we'll talk about today, you really the 20-day exponential moving average is a very simple tool, and if it's declining like it was here in the middle of May, we got a really sharp rally that was forecast in advance by the AD numbers, but there was really no signs of a bottom when it's declining like this. So you want to see it bottom out and turn up, then you have a chance that the trend is going to reverse. Currently, we don't see that, and after Friday's action, it's going to take some time. Clearly, last week, Friday's high and the 20-day EMA on the NYSE composite at 12,707 is a pretty strong area of resistance. Okay, so let's look at some of the examples. As usual, I'll try to break midway. If you have any questions, put them in the chat box and I will get to them. We have quite a few charts to cover today. First one, let's look at one of the first things I do when looking for a new trade or investment is look at the weekly charts and the weekly technical studies. Today we'll just really concentrate on the charts themselves. This is the XLV, the healthcare ETF. It staged a major breakout in 2011, 2012 through 10-year resistance. If you search back in the Forbes.com archives, you'll probably see an article about that. But then you can see that throughout this tremendous move, it came down and tested the 20-week EMA multiple times. All these episodes, whether it was like a 3-week setback, this one in early 2014, was about a 6 or 8 week pullback, held that rising 20-period EMA, started another move up. There was another one later in the year and continued to act as a good support level. So I look for new ETFs or stocks where the technical studies are positive and they've come back to the 20-period moving average, which is rising. That's the important one. The inverses will show in a few examples at the end. So in a downtrending stocks, you want to look to rallies back towards the declining 20-week and 20-day EMA. Let's look at a little close-up of the XLV, and you can kind of see what, here I've added the Stark bands, or the equivalent. You can see down here, Keltner channels 6 to 15. That's in one of the videos I put out. So, in 2013, we had a nice move up to the upper Stark band. We formed a doji, actually, and had a doji sell signal. We declined for another month or so back to the 20-period EMA and then moved back to the upside. Also in the summer of 2013, we came down and tested the rising 20 period EMA. Then in early 2014, you can see what we got up close to the weekly Stark bands, got this correction down. One sharp week down, we closed below the 20 period EMA, but then the next week we closed above it, and that was a sign that the bottom was likely in place. So this can be a very valuable tool to tell you whether you should be buying or selling, and what the major trend of a market is. So let's look at some other popular sort of ETFs and how they, let's look at the XLK. Okay, the technology one. I also had a nice run to the upside, little choppier. You can see that in 2014 we had a pretty sharp drop below the 20-week exponential moving average, but came right back up, and showing a very positive trend. Now currently, it looks a little more critical juncture here. With Friday's close, you can see we'd pulled back to the 20-week EMA 3 weeks ago, had this rally back up to the 80 level, but of course closed down 1.4% last week. So you can look at, the support around 75, there's a little support at the prior week's low, and then at 75, so that's, support first at 76.17, and then at 75.14, is what we'll be watching next week. Also, always important to look at the volume. The volume pattern here is not as bullish as I would like to see. You can see the rally we had up into August. The volume was declining. The volume has picked up in the past couple of, past month really. It was also strong in late last year. So the volume pattern, that's why the on-balance volume based on my work is negative on a weekly basis. Relative performance, remember that measures how a market is performing, vis-a-vis, the S&P 500 is still positive. Let's look at some more examples. Let's look at some individual stocks. I use the same analysis in individual stocks. You can see I've circled a couple areas. Early 2017, I look for a stock that's had, is in a positive trend. It's had a sharp pullback to the 20-week moving average, which is is still rising. You can see that was the case right in here. We had a sharp move to the upside. At that point, we can, if we add, the Keltner channels to that, we'll see that they respected pretty well too. So remember your inputs there: 6, 2, 15. Let's make this green, and let's make it stand out. So green thick line, and hit update. And you can see that, once again, Lockheed Martin triggered a weekly doji sell signal here in October of 2018, dropped all the way down in December, came right down below the weekly Stark band at the end of the year, and before it started its new uptrend. So still positive, based on the moving average is rising strongly, but we're still $20 ahead above the 20-week EMA. Remember, you can look in these little areas in here, and you can see 20-week EMA is at 351.90. The close is at 376. So it's going to have to drop $25. So for this stock, it's about 6% in order to get back to that rising 20-week EMA. So let's look a little bit more at LMT. See what the daily chart looks like. The daily, here we go. Oh, no, not getting ahead of myself here. So here's what the daily chart looks like for LMT. You can see that on this one, I've also overlaid the pivot levels. So you can see down here in the and pivot points down here, and let's change the color so they can, be sure let's change them to purple, and maybe, thick purple, and we can, so remember we did a class on this a while back, and its tape is on the, on YouTube if you want to take a look. So the solid line here is the pivot. One below it is the S1. First one above it's the R1, second one R2, conversely. So we had a nice run in 2019 up into early March. Then we had about a month-long pullback, and where'd that pullback took you below the monthly pivot here, but down into the S1 support. And then by early April, it had turned around here, had closed back above the monthly pivot for April, and started a pretty impressive new uptrend. It moved above the upper Stark band, consolidated another new high, hit the R1 resistance right here in early July, got another pullback. These pullbacks, often hold like they did here in May back into the rising period 20-day EMA. So that's kind of where I target my buy levels. I look at a chart and I say, okay, well, if it's going to pull back in there, what kind of stop can I use? So in this example here, this wide-ranging bar down here was a likely place to place a stop under that level to protect yourself in case the market reversed sharply. And you can see that, all these boxes are areas that the market has come back into and, held up pretty well and then moved even higher. So let's see, 9. Okay, let's look at Roku now. Roku has, of course, been one of the star performers. Let's look first at the weekly chart. Not been around for too long, so we don't have a lot of history. You can see very nice pullback in that from the March high into April. And while the market was correcting in May, it was skyrocketing. So those of you who watch one of the Bloomberg or CNBC, and you watch that tape at the bottom, I often don't have the volume on, but I do have the tape on, and see if the market is down quite a bit, what stocks are not selling off. There were a number of those on Friday, even though the Dow was down, 800 points, there were stocks that were just down 20 cents or so. Those are good candidates once the market turns around. So if you look at the Roku weekly chart, once again, we can add, the Stark bands to that, and you can, or the Keltner channels, which is the equivalent, and we'll quickly change the parameters here. To change, see we got right up near the Stark bands there. Also, 3 weeks in a row, we were above the Stark band in 2018, in the spring of this year, and had that pullback right down to the 20-week EMA. So, that they can be very handy, right? Earlier in June, also we tested that. We had a little pullback from around 108 down to 90, back to the upside. So right now, it's pretty extended. You can see we're up above the weekly Stark band for the last 3 weeks. So that's in a high-risk area to buy, a low-risk area to sell if you happen to be in this stock. Any questions? I haven't seen any questions pop up in the chat box, but I guess that's a good sign. I'll keep monitoring it, and but we'll have some time, before at the end to answer any questions. So let's now look at now that we've looked at the weekly chart, let's look at some of these little times in more concentration so you can see what I was looking at. So let's look at that action, in the pullback we had into May. You can see this is a daily chart. Just to reiterate, it has the bands, has pretty busy looking because I have the price levels in here. In blue here is the 20-period EMA. But, how could you figure out when that correction might end? Well, if you look at the, pick the annotate, and you do look at Fibonacci retracement, there was a low down here at 2630. You take that up to that high right here. You notice the high had just reached the pivot resistance, and that gives you your Fibonacci levels. So you may not be able to read this, so 55 and 49.81. So you came, right down in towards, this between 38 and 50% retracement with a low rather of 55.02 that was right above this monthly pivot support. Then you started to turn higher up in here. You can see both the on-balance volume and the RS, which measures how the stock is performing vis-a-vis the S&P, both turned around. Prices consolidated here the end of April before they took off. So there's plenty of time to get in this stock at that pullback, and the fib levels and the pivots kind of allowed you to target. We were up here at 74.35. We came down to 59, which was right at the pivot level, and another rally to 71.30. One more push to the downside. Corrections will often take different forms. So this is sort of the A, B, C sort of correction. And by using a combination of pivot levels and Fibonacci retracements, you can get a pretty good idea of where they may land. And of course, once you had this 55.02 level here, you could look back here and say where the support was really good in the 51 to 51 area way back on the way up. Remember, once a market moves through a resistance level, that now becomes support. So that's important to take a look at. So let's look at the current Roku trend here. Let's see which one. Daily. So this is a really simplified view, of what that whole decline in late 2018. You can see it also works when I look for short candidates. I look for those stocks or ETFs that have broken down based on the on-balance volume or the relative performance. And then I look for rallies back to the declining 20-day EMA for an entry point. So you can see we had back here in October, we dropped sharply, had a very nice sharp rally right back to the 20-day EMA. So you're not chasing the short side. You got another drop down back to the 20-period EMA. November, we moved sideways to lower, tested the 20-day EMA in December, and before it really got hit hard. So the high here was at 43.37, and then it got down to 27 by December 24th. So you can see those sort of levels. Also you can see, the sort of what I call, and one of my favorite sort of formations are continuation formations. So this was a flag or triangle formation that formed here in May, and we had sort of a trading range here that was completed on the latest earnings report, and it accelerated to the upside there. So it's a combination of tools here, I think, can help keep you on the right side of this market. So let's see what's next on my little agenda here. So I would recommend, remember, as a refresher course. So when you have weekly, when you have daily data, you get monthly pivot levels. So each month, and of course, remember, these levels are dependent and derived from the prior month's action. So they give you a different reading in most parts than you would get from moving averages or other techniques. So if you were to look at, an hourly chart of Roku, then you're going to get the weekly pivots. So this is, these pivot levels from a pivot of 134.49 to an R2 of 148 on the upside, 118 on the downside. They're derived from the prior week's action. And you can see, very bullish action here, and made a marginal new high here last week at 143.35, and it pulled back to Looks like we closed around 137.74, right back just above where the pivot was from last week. So once you get opening price levels on Monday, then you'll get new pivot levels. Somebody asked me, would I get into Roku right now? I always look at it in terms of risk. And so, right in here, if you were using a really tight stop, under, 130, if you look at the hourly chart here, in and out of it for a while, it was right around in 133, under 133 for a stop, then you're risking $4 on a $137 stock. So that's roughly 2 or 3%. Overall market action, Friday suggests we could see some more follow through. So, if we go back to the daily chart, I'd rather be seeing some action, back towards the 20 period daily EMA right here, which is 124.71. So you're $13 above that right now. So always, if you're long a market like you were up here, you're going like, well, should I sell or not? You want to think about, well, okay, well, my risk is, the potential to go back to that 20 period EMA. The daily studies were quite positive then. The daily studies are still positive right now. They're both above their moving averages, but they can still come back to those moving averages. So there's no real signs, of a top. You can see that during that, decline from, the middle of June, into the start of August, the RS dropped below its moving average. The on-balance volume turned negative for a few days, but then both got right back to positive after about a week's time, and have stayed in a positive trend, higher highs in both cases. So, we formed a doji on Friday up here. You can see that, remember a doji, we opened at 137.76 and we closed at 137.74. So why are dojis important? Dojis often, signs of indecision. So it's sort of a tug of war between the bulls and the bears. And oftentimes that can lead to a pullback depending on whether the market is overextended, on the upside or overextended on the downside. So for Roku, we're a little overextended on the upside right up in here, and a doji. So if we get a close below Friday's low, which was 136.95, I believe, that would signal, that a correction was underway. That could take you all the way back into that 20 period EMA. So kind of high risk in here, in my opinion. If you're a scalper and you see it, open positive on Monday morning, then using that 133 stop, might be okay. But otherwise, there's probably, other opportunities out there that you might take a look at. And, it's definitely been a great looking stock, but it has had some volatility. A lot of people, this decline right here was from 108 to 87. So that's $21. That's roughly a 20% decline in, 1, 2, 3, 4, 5, 6, 7, 8 days. So, money management, taking a 20% hit in 8 days is tough. Stop placement in this intervening low. If you're trading these higher momentum stocks, then it's usually a good idea to keep using a trailing stop. If you're a trader, if you're an investor, kind of go with the flow and don't use a stop, and if you've been in for a while, then you can use a wide stop and you'll still be having a profit in the position. But, risk management is critical. There were a lot of people that were hurt during the late decline in late last year because they didn't use tighter stops, and then they finally bailed out in December right as the market was getting ready to turn. So, that's the danger. On the recent, market decline a couple weeks ago, there was really signs of a panic low, and there was some, panic liquidation on Friday as well. that means makes a rebound very likely. But the market still has some work to do to digest all the crazy antics by various governments that makes it difficult for stocks to go up. The inverted yield curve still hangs over the market. I'm not particularly worried about it right now. There are a number of other economic indicators I'm looking at that I think are more important. But inverted yield curve going back into the 50s, it typically inverts 12 to 15 months ahead of time. So, but it's gone as little as 6, I think as many as 18 or 20. So, not much of good. My belief is that you'll get stronger negative signals from other technical studies than you will from economic data. Go back to the 20 period EMA, there's been a lot of, so this is, China Petroleum and Chemical, a real dog. And you can see I just used it because it just, maintained the 20 period exponential moving average throughout this decline from 80 down there. So if you're short, you get down in here, and I think you probably can imagine that if we do put the channels back on here, that this level down in here, this June low, it was down near the lower band, whereas an area that if you were short, you say, well, okay, well, I think I've had my run for now, and I'm going to step aside. Got fairly close to it down in here. We got down to the S1 support, rallied right back above the pivot briefly at the end of June, back to the downside, and has still been bumping into that 20 period. So if you're, whether you're on the short side or the long side, first thing to look at is a 20 period EMA, see where your position is, and and use that as a guideline. For the overall, for trading, or if you're, even if you're an investor, I think that's a wise choice. Let's look at one more, and then I'll answer some questions. So COM was another one we liked, from the short side during May, and it was just sort of, it had broken down here, and then it's still, it just kept bumping into that 20 period EMA and had quite a run to the downside. So it lost half its value from about 26 down to $10 right now, and it's well below that. So I measure the difference between, the price and the 20 period EMA. So first thing, direction. You can see during this decline in October, it broke down right at the start of the month, rallied back towards it, in early November before another downdraft. It looks like obviously an earnings report here, but it went from 25 quickly down to 19, so that was a 20% move, and then lost another 20% before things bottomed out in December. So it's if you have, one question I often get, and from people is, how do you get started in becoming a better analyst and understanding the markets better? Obviously, I try to teach as part of my publications, but also I find that many people just don't look at enough charts. I had a Twitter exchange with a nice gentleman, and I pointed out, I think it was Netflix. Let's look at Netflix. That had some really negative technical signals before that latest earnings drop. But here's the daily chart. I think I was talking about a weekly chart, so let's look at the weekly chart. And I'd pointed out, so let's see here. Chart, no, 6 months maybe. That everything has started. The on-balance volume in early July, the week before it reported earnings, it all deteriorated. And if we look at a daily chart, you will see that's even more clearly. And they said, well, gee, it'd been really nice to know that. And I said, well, my view of the market, back then was positive. So I don't look for short candidates when the market's positive. And also I look at 600 to 700 charts a week. And so then he was a little more understanding that I'm not going to be sending out an update on an individual chart, just that I happen to write about in my Forbes.com column. But the bottom line here is that you really need to look at charts. So, people I mentor, if I look at their portfolio and I see they have 30 stocks, I tell them, okay, so, every day now, if you aren't looking at charts, look at 5 of those. Figure out what you think about this chart based on first the weekly and the daily charts, and rank whether you think it's positive, negative, or neutral. And then, identify some support levels. And that's going to get you started. Then every week, look at the weekly charts. So our routine is important. You can see with Netflix, we dropped from 384 down to 305, rallied right back into, first resistance here, this 332, 336 area. Remember I just commented that, this was important support. And if we look at, let's, draw some lines in here, will become even more evident. See, we just, kind of rallied right back up to that resistance level before another downdraft. So, if you were starting negative after its earnings, you're bumping into the lower Keltner channel here. You got down to 305, you rallied up to 337 or so. So a 10% rebound. So if you were pressing the short side, if you're looking to sell something short, use these, Stark bands, Keltner channels. Remember on Yahoo, you can get the actual Stark band. These numbers are a little different, but they're pretty similar. And if we go back to the weekly chart, somebody didn't ask me that. And I'll look at the weekly analysis. I believe still looks pretty negative to me, so I'm not really looking for a turnaround in Netflix at this point. We're black, below the yearly pivot right now. If you look at the RS is below its moving average, on balance volume looks weak, so it looks negative. Still that resistance around 336, but it looks like it's heading lower for a while. And you can see the 20-period EMA now in blue. In this particular instance, is at 336.35. So that's your resistance level. And until that starts to flatten out, like it did here, in the start of 2019, it's probably still in a downtrend. So that's kind of the message for the day. You can also look at a weekly chart, a monthly chart rather, and you can see what, monthly studies look like. Monthly, are about ready to turn negative depending on where we close the month. So that's also not a good sign. It's hard to tell here, but the on-balance volume is close to dropping below it, and the RS is also. So then you're looking back at, some really, major support, is 231.23. You probably can't see that right in here, but that's a 231 area. That's an area to watch out for. Okay, a couple time for little questions. Tom, would you keep your long-term investments in U.S. and China equity funds? Well, I don't really have a lot in China, so right in here, I've been in and out of FXI periodically and out for a good part of the year. Yeah, long-term investments, I'm still holding on those at this point. I don't see strong evidence of a bear market or a recession. So, currently, as you mentioned, the daily AD lines are all negative. Only two of the 6 I follow, weekly AD lines are negative. So that does allow for, some problems in the next month. September is usually not a good month. In October, things start getting a lot better. So hopefully calmer heads and real economists will get involved in our policy, and we'll have a better, shot at sort of, avoiding the chaos. Markets don't like chaos. Apparently there's not a lot of people in power that understand that, but, business leaders, company leaders, you're not going to start a new factory if you don't know what's going to happen. And, that's fine. You can, move your supply chains to Thailand, but there's no guarantee that Thailand's not going to show up on the blacklist as well. So, that's sort of hard to gauge. let's see, AD lines do I follow? So I follow the two I showed you earlier, the NYSE All AD line and the NYSE Stocks Only. They're available both on, here we are, both on stock charts. In fact, all the ones I follow are. So you can see the $ NYAD, and this is a little more complex, but if you search for, stocks only, you'll come up with this one. Then I also followed the Dow AD line, the S&P 500 AD line, the NASDAQ 100 AD line. So that's the total of the 6 ones that I do follow, and the Russell 2000. So the Russell weekly has been pretty much negative all year. It popped positive about a month ago, but it's been negative. This week, the stocks only one turned negative, and the other ones are still positive. We had another week of selling similar to this last week, which was pretty much the same. There's about 1,100 stocks up on a weekly basis and 1,800 down. Another week like that going forward probably would turn another AD line, a weekly AD line or 2 negative. So then you kind of get back to the neutral. Now, right down in here, sure, there's pretty important support, around 2,800 on the S&P. If you get below that, there's 2,750. Really, the economic data shows some sort of slow deterioration, but nothing really earth-shattering. If you start to see the unemployment numbers move up and consumer confidence really, start to roll over, that's going to be not a good sign. Somebody asked me 2750 Dow Jones. Yeah, I don't really, the Dow Jones is not in my, representative index. I mean, I follow it. I occasionally invest in the DIA. Problem is it's 30 stocks. So you don't have a very, S&P 500 is a much better gauge. So if you study the history of the markets, I have Dow data going back to 1906, I think. So there are a lot of times when, the Dow stayed strong or stayed weak while the rest of the market was turning around. So I would look at some other market averages, to gauge, what the trend of the market is. Last question, somebody's asking me about McClellan Summation Index. Yes, I do. It's a cumulative reading of the McClellan Oscillator numbers. McClellan Oscillator formed a nice little divergence at the recent lows, and let's see, maybe I can pull up. Let's see if I'm here with me. I'll find. I do follow I teach in my AD line course. The McClellan Oscillator is not always valuable the way I use it, but it can give you some really good signals sometimes, and but not all the time. So I look at it in terms of what it's saying to me versus the AD line. So that's the most important part here. Let's see, where am I? It's daily summation. 5, maybe this is it. Oh yeah, here's so this is down here. This is a short-term overbought oversold indicator I teach my students about. So this is the McClellan, 2 different versions of the McClellan oscillator here. You can see that they had a nice divergence at that last low. Made a new low here, and it was forming higher lows. That was a short-term positive signal. We moved above the 0 line in both instances. Now we're back down. So it's kind of crunch time. You need to have positive AD numbers early this coming week to make it hold that support. And then, that will keep this short-term uptrend intact until right now, it's still positive. So, well, 11:39. So, if those of you who are not subscribers to any of my advisory services, if you go to viperreport.com, you can sign up for the Viper ETF report or the Hot Stocks report. I'm going to be, I'm working with a group of students right now that are taking the Advanced Decline Line course. And so with the crazy action, we've spotted some really deeply oversold areas that, like just a week ago, that where the ARMS index hit 3.74, I believe, and create a really, the Dow 800 point down day, picked up some, cheap options that in a couple of days doubled. not always the case, but at least you know they're at a pretty good risk when the market's that oversold, because the rubber band effect will take place. So, if you're interested, you can read about it on the site or sign up for the services. I do try to teach during my regular Viper report and Viper hot stocks, so you might learn some more about it. Somebody asked about the unbalanced volume versus accumulation. I like the unbalanced volume better than the accumulation distribution. You'll get something similar. TC 2000 has something called time segmented volume. I just work with the unbalanced volume. I'm in for decades, so I'm most familiar with how it works and what patterns, and it has some significant patterns. AD course is live, just one student and me. We set up a section on Zoom or on GoToMeeting, and it's like over 6 hours of individualized training. Each session usually runs about 90 minutes, and I do send test questions out between courses, and so I want to be sure you're following along, and it does require good participation by the student, and then there's follow-up. So this page here tells you a bit more about it, some of the feedback. I've gotten some from some of the past students. So first step is, if you're interested, you go on the page and sign up for the course and pay for the course, and then we'll set up a phone call, and during that phone call, it'll help me decide whether I think the course is well suited for you, and it'll also allow you to determine whether it's something you want to do, and if not, then we just refund your money. The reason I have you pay first is the fact that I do get a lot of tire kickers that people want to pick my brain and take 20 minutes, half an hour of my time, and really never want to buy anything. I've been doing this too long. Life's too short to do that. So I've had one student that I turned down, I think, in the last year. And other than that, the ones that have signed up have all had really positive responses. So that's enough for right now. I'll be posting this sometime next week. I'll send out an email if you signed up for viperreport.com. If you go to the homepage here, you click on this ebook thing, it'll get you on the list. And I send out emails to get new Forbes articles, as well as let you know about videos that are available, and they come out usually twice a week. So if you're interested in keeping up with this, please, if you get the video recording, answer my questionnaire about the survey about the videos. I need your feedback. So we're working through some of the subject lists that all of you have indicated you're interested in. So I'll probably add another one to the next survey. So that said, you all have a great weekend, and thank you very much for joining me.